Get ready to peer behind the curtain of the private equity universe with each episode of Best But Never Final. Hi, I'm Lloyd Metz, joined by Doug McCormick and Sean Mooney. Together, we'll navigate the corridors of private equity, revealing the uncommon knowledge, challenges, successes, and lessons that drive the world of private equity and business forward. Let's go.
We have another great episode today where we're going to talk about value creation from both the lens of the private equity firm, but also the portfolio company CEO. So today we're really fortunate not only to have our co-host extraordinaire, Doug McCormick, who leads HCI as their managing partner and chief investment officer, but we also have Scott Milberg, who is CEO of HCI portfolio company, AmerCareRoyal. So Scott, thanks for joining us today. Doug, thanks for being here again, once again.
Good to be here.
My pleasure.
So our listeners, of course, know the one and only Doug, so we're not going to flatter him anymore. I think what would really be helpful and valuable to our listeners is to spend some time getting to know Scott a little bit and AmerCareRoyal. So Scott, can you share a bit about yourself and your business?
Yeah, you bet. So my name's Scott Milberg. I've been the CEO of AmerCareRoyal since 2019. That was after starting my career in the food service disposable space back in 2001. So I was actually with Royal Paper Products, which was a third generation family founded business. We were a manufacturer, converter, and importer of a wide variety of food service disposable products. We serviced the entire country, founded in 1949, actually. And so we were acquired by HCI in 2016 as part of the platform investment, which has evolved into AmerCareRoyal. Today, AmerCareRoyal, we are a leading supplier of critical disposable products and supply chain solutions. And we service an enormous $43 billion food service industry throughout North America. We have a combination of domestic manufacturing as well as global sourcing capabilities that we provide packaging and supply chain solutions to all of our customers. We're focused on supply continuity. We're focused on managing costs and removing risk and really building a partnership with our critical customers.
That's interesting, Scott. I'm curious here, were you part of the family or did the family bring you in or did HCI bring you in? How did you become part of the story here?
Yeah, I was part of the family that started the business, started in Coatesville, Pennsylvania with a paper coaster, actually. And so a grandfather who came from Germany came here, recognized an opportunity to put coasters on the counters in bars and diners in the US. And at that time, the food service distribution business hadn't really emerged and hadn't evolved. There weren't redistributors, there weren't broadliners. And we started to sell coasters and paper products up and down the streets out here in the Northeast. And that evolved into what was Royal Paper, which I led as president through 2010 to 2015.
If I could just comment, all of these partnerships, all of these journeys are so unique, and just a couple comments on the unique aspects of AmerCareRoyal. So we've been in this partnership for an abnormally long time, almost a decade. But through that time, we've seen just tremendous transformation on a couple levels. So the business that we started with in 2014 was about 40 million of top line revenue. Today, it's over 900 million and approaching $1 billion. So kind of tremendous kind of growth trajectory. But also it's been fun to watch Scott's own journey, right? So Scott was a young and up and coming executive who had tremendous kind of functional knowledge and depth, given he'd grown up in the industry. And to watch him kind of evolve his leadership skills and develop as the organization's developed, has been a real fun part of the journey that we've had a chance to kind of navigate together.
I love that story. And it's really interesting, just, kind of personally, as I kind of think about your experience. I grew up in a third generation family business. And that was a small little company that started in Cleveland, Ohio, and then it evolved literally across the globe. And so it's a great way to grow up. I'm guessing if your experience was anything like mine, I always was given the hardest job that was ever given to anyone and have all sorts of stories about them, I think, giving plant level bonuses when they kind of messed with me as a kid. So
yeah, it's been a ride for sure.
That's great. We'll dig more into kind of this journey of value creation you have, but I think it might help to give a little bit of some background on this episode. And so for our listeners, I think, we've already discussed quite a bit on the Best But Never Final podcast here about how and why value creation is so important in the private equity world. And a little while ago, Doug and I were catching up and talking about this study that we kind of looked at together about the Inc. 5000, where when we pulled back the cover, it showed this really strong role by private equity in these kind of small and mid-sized businesses growing into quite substantial companies like AmerCareRoyal has become. And maybe just to share the cliff notes on this study, is we were looking at this and Doug and I were peering into this. It was interesting because we saw 11% of the Inc. 5000 companies were PE backed. Those companies on average grew 480% over 3 years. And what was really striking to me is not only were they growing, but maybe 11% of the companies were PE backed, but they accounted for 64% of the jobs that were added during that 3-year period, which is striking. And then we looked at the data that we had within Blue Wave, working with a large number of the private equity industry business builders. 77% of our projects last year were related to value creation, and nearly 1 in 2 projects were related to human capital. So this all made sense. And so Doug and I were talking about it'd be really interesting to talk about private equity's role in value creation, not only through the lens of PE, but also through the lens of a CEO who's along this kind of common journey. And so maybe that is setting the stage. I'd love to kind of get into it. And Doug, I'd be curious. One of the things that we talk about all the time is this value creation concept. And Inc. 5000 shows a lot about how private equity approaches this. How is this kind of shown out in your portfolio companies? Do you have companies in Inc. 5000?
Yeah, Sean. First of all, I think just the genesis of our discussion, I think is interesting to just kind of put a point on, which is as private equity's matured, driving value has become more commensurate with driving growth because the market's become increasingly competitive. It's harder to find value. And so I think private equity firms have figured out a variety of tools to accelerate growth. And I think that's interesting, not only from an asset class perspective, but it's interesting from a public policy perspective as we think about the implications for employment and just good corporate and economic policy. I'm very focused on the study because we have been the beneficiaries of several awards. So in 2023, we had 4 portfolio companies that qualified for the Inc. 5000's fastest growing companies. Over the last 3 years, we've been an award recipient 11 times. So kind of really good traction relative to the metrics that Inc. 5000 uses. In our most recent submission, which was 2023, I mentioned we had 4 award winners. One is MSI Express, which is a manufacturer in the food equipment space. It does co-packing and co-manufacturing of actual foods. We had one business that was a technical service business called Tech24. It does food service equipment repair. And then we have 2 distribution businesses. One was AmerCareRoyal, and the other is CHS, Consolidated Hotel Supplies. So anyways, pretty disparate group of businesses that I just mentioned. But I think the common thread across all 4 of those is we partnered or purchased from a founder or family. So it was direct purchase from an entrepreneur who had big visions. The second thing is they're all consolidation strategies, right? So we picked really fragmented markets in North America where we could dramatically scale the business, not just through organic growth, but through acquisition growth.
That makes a ton of sense. And maybe to dig into this, and we'll get into the how and the why a little bit more here, Doug, but how does your firm, HCI, think about value creation in general, specifically as it relates to kind of this topic?
Yeah. And again, there's a whole bunch of different unique strategies as you think about value creation, but holistically, at a very high level, we try to have a pretty standard engagement model. And we're essentially trying, if you think about the goal very simplistically, it's drive transformational growth where we can build not only a bigger business, but a better business. And as I mentioned, the market's got so competitive. What you do with the asset, I think, ends up being the primary driver of returns. And so our playbook is we pick fragmented industries where we can execute this consolidation strategy, but the value goes far and beyond simply just M&A. While you're executing that strategy, you're growing the team, you're growing the organizational capabilities because you've just introduced all kinds of complexity with a bigger business. And along the way, you're also giving the team more tools to win or a better mandate to win. And that comes through organic capabilities and the businesses we buy. Every time Scott consummates an acquisition, he seeds his product portfolio with a new geography or a new product set that he can provide to his existing customers. And I would say the last thing is we try to stay disciplined and steady and committed along the way. None of these strategies work out exactly as you pencil them out on paper. And so I think the ability to kind of stay the course and remain committed to the end state in the course of growing pains is an important part of the journey.
We're really, as part of this conversation, kind of starting at the high level. And Scott, I'd love to get your perspective as we drill down here. But maybe before we get there, just addressing kind of one of the interesting takeaways that I saw from the study. If you want to find the study, you'll find the link to the study in the episode notes. One of the things that was so striking from the analysis that we did was this whole concept of jobs and job creation and job additions. Doug, I'd be curious, why have your companies and why has PE in general been such a big job creator, not only in the Inc. 5000, but also broadly across the economy?
As I mentioned earlier, as things have got increasingly competitive, I think growth is required to deliver the returns that we're all seeking for. So that's essentially our mandate from our investors. And I think the private equity market brings a couple key resources to these consolidation plays. They bring access to capital, right? I think that's an important one. So we can essentially accelerate the rate of investment in the businesses we purchase. And that rate of investment can be deployed organically or acquisition, in either case, kind of translating to growth. I think we can complement the team with M&A capabilities and business capabilities. And so in the early days, Scott and his team didn't have an in-house M&A team. So we provided that support as they thought about navigating acquisitions. Over time, they've internalized many of those skill sets. I would be remiss if I didn't say one of the powerful attributes of the private equity model is this alignment of incentives. It's alignment of incentives between our investors and HCI, and then it's alignment of incentives between our investors, Scott and his team. So we're all incented for that transformational growth and the value that resides from that. And while it's easy to say all of those things in a very high level, general way, I think AmerCare is a great example of that journey. We've added significant human capital, both at the senior level and the employee level in Scott's journey from 40 to 900 plus.
40 to 900 plus just kind of makes my head explode. Is managing a company that has around close to 50 people. I don't even know how you've made that journey, but maybe Scott, let's bring you in. Can you talk about what are the nature of these jobs that you're building here?
Yeah. So look, just to kind of frame the concept of job creation, right? I think the growth aspirations are really what has been a game changer from a single entity to where we are today, right? When the expectation of single digit growth is good enough, you don't have to make the investments. You don't have a vision of what the business could become. A lot of times debt is a bad thing. And you don't realize that leveraging the business through a little bit of debt can allow us to accelerate that growth. And I think a PE sponsor helps us recognize that. And so when you have that expectation for exponential growth, you have to have the bodies and the jobs and the roles and the people to support that. I want to say that we now have close to 850 employees across the organization. We have dedicated staff, full-time employees overseas in China, in Turkey, in South America. We are focused on everybody from the shop floor all the way up to not just the C-suite, but 2, 3, 4 levels down in order to really drive and deliver on our initiatives. We used to joke at some of the early board meetings. It was like, I would say, you guys need to make an investment into analysts, right? And I would look at Doug and I'd be like, we have an analyst. We have one. What do we need a second analyst for, right? And at that point, we're like an $85 or $120 million business. And today, Doug often says, you want to skate where the puck is going, right? We want to build the business for tomorrow and not for what we have today. And now we have analysts, just as an example, but there's analysts embedded in almost each function of the business, right? And there's functions within the organization today that just didn't even exist before, whether that's in supply chain, manufacturing operations, human resources, technology, finance. I mean, the organization and the organizational design, the number of people, the level of skill that we've hired, the sustainability of those jobs is really what has transformed us and makes our growth possible.
I want to be intellectually honest that as you think about AmerCare's growth and growth in employment, Some of it has been acquisition related, right? Where we've acquired the same way we acquire customers, we've acquired employees. And so we've grown our employee base that way. But this specific example, just to point out, Scott mentioned we have about 800 employees today. I think we've grown our employee base by over 400 organically. And it's also important to point out kind of the types of skill sets that we've added. In addition to growing the headcount, I know for a fact we've added over 30 senior managers. And in many cases, these positions didn't exist, right? A CIO, Chief Information Technology Officer, right? Like that would have been a position that the business didn't have. And so Chief Commercial Officer is a position the business didn't have. So we really added capabilities by functional capacity as well as just headcount.
Yeah, I want to say there's probably around 80 new positions, right? Lots of investment in management, but net new positions that didn't exist in the organization. I want to say there's almost 80 new roles that have been created to meet the needs of the business.
Hey, Scott, just to be clear, that's 80 roles, not individuals, right? So like a role could have 30 people in it.
Correct.
As you're thinking about the journey that you've been on with HCI, if you go back to the Wayback Machine before you had kind of the fuel in the tank to kind of really throttle down on what you've achieved, could you even had all those type of roles?
No, I mean, the demand wasn't there, right? Like the expectation for growth, the initiatives that we were focused on as in the Wayback Machine, they didn't demand or they didn't require these positions or these skill sets. So it really just speaks to kind of not only what we're doing today, but the type of business that we're trying to build for the future, right? And being proactive and getting ahead of what we think are the next set of risk or the next set of opportunities to make what we're doing sustainable.
I think this also speaks to kind of the broader private equity model, right? Like the reality is this business has performed way better and grown way bigger than we would have ever anticipated in any model or thesis or forecast that we put together. But, early on we knew it's a $40 billion market and it's relatively fragmented with some really nice kind of organic growth trends. And so some of the game, I think, from a private equity investment professional is you feed your winners and you starve your losers. And so this one's just been way more kind of productive in terms of our ability to deploy capital effectively to really grow that business. And you can play a little bit of game of incrementalism, right? Like we did a deal, we learned from it, we did a few more deals, we learned more. And so we didn't have a real clear path of where we were going other than it was a really big sandbox to play in with a really attractive business model.
This episode is brought to you today by HCI Equity Partners, a lower middle market private equity firm focused on partnering with family and founder-owned manufacturing, service, and distribution companies. ICV Partners, an innovative private equity firm supporting management teams of leading companies at the lower end of the middle market. And Blue Wave, the business builders network connecting the most proactive business builders in the world with the best of the best service providers for critical, variable, on-point, and on-time due diligence and value creation needs. Now back to the episode. We'll turn the page in a second because I want to get Scott's perspective on this whole kind of value creation, business building perspectives you think specifically and kind of your core philosophies. But maybe before we go there, one of the things I think is interesting as I'm reflecting on what both Scott and Doug are saying is this whole concept of the types of jobs that you're creating. It's everything from the entry-level jobs, the shop floor jobs, the doer jobs, the mid-level jobs, the upper-level jobs. It's kind of this microcosm of the economy all in one business here that you're building as you kind of grow the company. Is that a fair kind of perspective?
Yeah, I think it is fair, and it doesn't happen all at once, right? I mean, I think that in some ways we're kind of building from the bottom up because we're trying to build capacity to satisfy demand. And in other areas, we're building from the top down, or because we've made an acquisition and it requires a new capability and it requires leadership and vision to then come in and build out their team, right? To build out the middle level of the employee base. So I don't think it's always starting in one place, right? But it fills out from the bottom to the top or the top to the bottom and everything in between. And you end up with a really robust workforce that understands the vision of what we're trying to build and is connected to how we're doing it, how we're getting there.
I also think there's a really interesting kind of corollary of, I would argue, regardless of where you are in the organization, the employment prospects for that individual are better in a growth-oriented company than a non-growth-oriented company, right? And it's how fun is the job? It's the cultural aspects. It's also the economic opportunities and the professional development opportunities, right? So in a growing business, we've had a chance to allow people to progress and migrate into new roles with greater responsibilities. And so there is this virtual cycle of, if we can create that growth engine, not only is it a great economic outcome, we're not creating jobs for people, we're creating professional opportunities and growth for people as well.
I think the development is critical. And I think, like you said, we're not creating jobs, we're creating careers, right? I mean, it's a long-term investment in our people.
And I love that, right? All things being equal, if you're a growing company, not only you're growing the top line, but you're creating opportunity for careers. And maybe that's a nice segue to digging into, Scott, your perspectives and philosophies on business building. And so as you've gone along this journey with Doug and team, what have been the focus areas that maybe you've thought about how you really exponentially scale a company, which it's got to be a tremendous source of pride, but to me, it's mind-boggling taking a company from 400 to 900 as you have. And so I'd love to hear more about the philosophies
Sean,
that you've used.
don't downplay it. 40 to 900.
37. I think we started at 37, but
That's now my head's
and it should be closer to $1 billion by the end of the year. But look, I think it's a fitting kind of transition, because this isn't about just me, right? Like, we're talking about jobs and we're talking about people. And I think that's the critical piece to the puzzle and the foundation of what we've done. It's about the investment in people to build the teams and to build the capabilities that would allow us to sustain and even accelerate growth. And this is an area that, quite frankly, coming from where I came from in my career, I didn't appreciate the level of investment and kind of forward thinking that was required in order to scale the business. And it's a great example of where, in this case, HCI was a good partner, right? And they talked about what an org needs to have and what the design of the org needs to be able to support if that vision is to really get the business to $1 billion. So I think understanding and accelerating investments in people was kind of one of the first of what I'll call 4 pillars, right? In terms of creating value as we've been on this journey. I think the second pillar, I would say, is just, broadly speaking, it's integration, right? But it's not just IT systems integration. It's about people, it's about culture, obviously, right? But it's really about the functional areas and the value within each one of them that is created through integration. When you have 6 companies or 9 companies now that you've put together, but you're operating as 6 independent supply chain organizations, it's really hard to capture or create value, right? Even when you don't have one common platform or one reporting system, or you don't have visibility to the spend across all these organizations. So driving integration across supply chain, across warehouse operations, across sourcing, across manufacturing, those have been kind of critical value creating levers that support this pillar of integration. Third, I think once you have the people and you have the integration, then you can do some of the work, some of the fun stuff, right? Some of the transformational initiatives that really create value, not just for stakeholders, but also for our customers. So expanding those capabilities through having the right people, through having the right integration points, allows us to create more value to the customer, ultimately, and accelerates growth. And it also helps us reduce cost, right? And so we're in a business, we're a distribution business where we're either making or sourcing a variety of disposable products. Anywhere between 70 and 80% of our costs is in our product cost. So anything we can do to reduce product or operational cost, not at the cost of jobs, but to actually reduce the cost of goods, can create significant value, especially when you're doing it at scale, right? So as we continue to grow and get to the level where you're moving millions of boxes, right? Pennies and cents matter, they add up. The fourth pillar, which is really around M&A, and that's been a huge part of our growth, right? And I think when we look at the very start of our engagement with HCI, we recognized that it was a ridiculously fragmented supply base and that our market was really ripe for consolidation. There had not been a huge consolidation play, that we recognize that our customers appreciate the value of the bundle and what we provide. And so bringing what HCI brought to the table in terms of leveraging our access to capital markets to drive that consolidation model has been a huge accelerator and has allowed us to take share in the market.
What you said there makes a lot of sense. And as I reflect on the industry at large, or the business world anyways, I always think about through this concept of expected value. And maybe there's a couple approaches to growth. And the VC model, and this is by no means something that I'm saying is bad about the industry, but they're going to go fast as they can in hopes of getting to orbit. And then some small percentage will make it into orbit. What I heard you talk about was a very kind of methodical approach to growing quickly. Get the people in place, get the capabilities, the processes, and then you can optimize as going along. So it's more of like a jetliner getting up to 35,000 feet at a fast pace, but not trying to do a moonshot. Is that a fair?
Yeah, I think that is. I mean, I think you can't build a house on a weak foundation. And I think creating that foundation is critical. And I think that it often takes more time and more money than we want. But I think if we stay committed to the long-term opportunity in the business, like Doug mentioned earlier, we've been able to deliver those results.
I think it makes a ton of sense. And kind of bringing this back to kind of expected value, as you said, it may have taken a little longer, a little more money, but if you multiply the outcome that you've achieved times the probability of success, it seems to have delivered a much more certain outcome than maybe had you taken other approaches.
You got to ask Doug. He's the ultimate scorekeeper, but I would agree with you. Yeah. Listen, I think that there's lots of ups and downs. Things don't always happen the way we expect, but ultimately we're getting to a better result than we had anticipated.
Hey, Doug, what are your thoughts on that?
So I think Scott's being humble there. I think these guys have done a great job on delivering on the promise and the opportunity that we all kind of saw when we joined hands to embark on the journey. I think as I reflect on how Scott has thought about the four pillars, I'll take the converse way to say that I think two of those pillars are the way that consolidation strategies can really get messed up. If we say, hey, boy, this just sounds too easy, just put a bunch of businesses together and create a big business. But I think this integration work is really hard. And if you do it well, it allows you to both play defense and offense. I would argue that acquisitions you do that are not integrated, you have an Achilles heel because you really don't know what's going on. And it's hard to kind of play defense. And at the same time, we're buying these businesses because we think there's some kind of synergy, whether it's the opportunity to buy better or the opportunity to sell better or cross-sell or price differently. And it's really hard to get at those opportunities unless you have good data, good information, and good integration. So like Scott's business is a distribution business, and that's a core competency, all the things related to distribution. But at the same time, I think M&A integration, new organizational onboarding has become a core competency and must be. And then the second one, I think, is he always talks about customer focus, and you got to be customer centric on this stuff and make sure that the business you're buying, you can get your head around having conviction that it allows you to better service the customer, whether it be with new capabilities or a better cost position. I think if you stick to those two things in these consolidation strategies and you do those well, assuming that the markets behave as you expect, et cetera, I think that goes a long way to ensuring success.
It's interesting as I'm listening to you all speak, there's a couple things that jump out to me. One, you're using the word and a lot versus or. So you're taking this comprehensive approach. It's not we're going to do one or the other. We're going to do acquisitions and we're going to use data and we're going to add people and we're going to build sustainable jobs that lead to careers. It's not one thing. It's a multiple number of things that are all working together in symphony. And I think that's really important for any business builder to think about. You got to build a system that's comprehensive, integrated, and doing multiple things that work well together versus just hitting one button. One thing, Scott, that I didn't hear you talk a lot about that I think a lot of people maybe perceive from like 1980s movies is this idea that we're going to get there by cutting costs. I heard you're going to optimize costs and you're going to be efficient, but I didn't hear like, oh, the path to Rome is like, we're just going to cut. How does that play into the way that you think about building your business?
Well, look, I think that we're a growth company. We're a growth-oriented company, and I think we've got a growth-oriented sponsor in HCI. And I think that we think about reducing cost differently than cutting cost in terms of bodies or jobs or roles. We focus on, like you said, more optimizing our cost and making sure that if you're thinking about people, we think about, do we have the right people in the right roles? And we often try to utilize the people that have helped build the business and maybe in different capacities in different places to help generate upside revenue opportunity versus kind of cutting costs, eliminating office space. It's a cliche, right? But it takes money to make money. And I think we got to invest, especially at this stage of our journey, to support what our goals are in terms of exponential growth. So we're going to continue to invest in people, process, and systems. And that doesn't always correlate directly with cutting costs, right? Ultimately, we get to a lower cost point, a lower cost of goods, a lower cost to serve, but it's through the investments that we're making, which come at an expense more so than at a pure removal of cost.
I want to be intellectually honest on this one. So if we thought that any of our investments was overstaffed or was at a scale that was inconsistent with revenue base, we would take costs out. And if that meant employees, we would make that business decision as well. Having said that, I guess two observations. This game of cost management, as it especially pertains to employees, in my mind, is a direct reflection of the quality of the end state opportunity and the rate of growth, right? And you find yourselves in these markets like Scott's competing in, and the market is always growing at a rate where you're always trying to keep up. And so you're investing today for things that you're not going to really take advantage of for almost another 6 or 12 months. And then the last thing I'd say is just about the lower middle market private equity business. I mentioned earlier that the 4 businesses that we were recognized as Inc. 5000 growth winners, if you will, were all purchased in partnership or purchased from a family. My experience has been Scott's family had less ambitious growth aspirations that allowed them to run the business a bit more efficiently and more leanly. And so the reality is we often feel like the businesses we're buying day one are understaffed relative to where we're headed. So we rarely find situations where entrepreneurs have overstaffed their business because they're paying themselves out of the profits at the end of the year and they're focused on the bottom line.
I think that's a great point.
And I think those are all very spot on observations and perspectives. And one of the things as I think about previously investing in family owned businesses, there's usually a J curve because you're going to enable the fuel to make those investments that maybe are harder to make in the precursor state, or you couldn't even make them. And then as businesses get going, as I always think about, the first half of my career was in industrial private equity. And so I love this concept of lean and Six Sigma. And so it's this idea that the noble thing is not to get overweight because that doesn't accomplish anything and it throws off the whole system. The noble thing in terms of building a company is to be lean where you need to be lean and pre-investing in other areas. What that ultimately enables you to do is create cash flow that enables you to reinvest, that enables you to add more jobs in the right places, that enables you to grow faster. And so it's all kind of this integrated flywheel that I'm kind of hearing you guys say here. Is that a fair kind of takeaway?
Yeah, I think it is, Sean. And I would say just one reaction to the way you described it. I think it's hard for organizations to invest in certain parts of the business and disinvest in other parts of the business. And we find as if you're transforming a business, that's going to happen. Certain parts of the business are no longer a priority or required, and other parts you've got to really invest in. And so you got to avoid this concept of share the pain or share the opportunity and concentrate your bets on where the choke point of growth is.
And I think, listen, this is not a steady state model, what we're doing, whether that's because it's a consolidation play or not, but we're going to stay nimble and we're going to react to a dynamic market and we're going to react to the dynamics of our customers. And so to Doug's point, I mean, I think we're constantly challenged to pivot and to change what we're doing. We have to be able to throttle up and down or move left and right as defined by the needs of the market and by the customer.
There's this kind of line, all roads lead to Rome. And there was this concept that everyone thinks it's a straight line is the fastest way there. And often, as you're going through journeys and building companies, it's really more of a twisting and turning road. And it may seem like you're taking the long way, but you're going around the mountain passes and you're going through the rivers. You ultimately get there a lot faster, but it's never straight. There's always dips and turns and twists. But ultimately, you get there. So one of the things maybe that we can talk about next, Scott, is with all of this in mind, how has this approach really enabled you to serve your customers, your stakeholders in your markets in kind of different and better ways?
For us, there's a ton of value that we create for our customers through our size, through our scale, right? Our ability to service fast growing concepts or national brands throughout North America, into Canada. A lot of that value has come through the consolidation and the growth that we've delivered. I think that there's a tremendous amount of flexibility that our model has also brought to our customers, or value creation through our flexibility, right? Customers often want to move from one substrate to another substrate, depending on what's going on in the world. They want the lowest cost product. They don't care where it comes from, to something that is nearshored or onshored. There's always a focus on breadth of line, right? I mean, so being able to go to our customer base and say, hey, we can provide the best of both worlds. We can make, we can source, we have it onshore, we have it offshore, we can service throughout North America, regardless of where you're located. And we can provide that same level of consistency through best-in-class people, best-in-class capabilities. Those are big value creators to our customers. And ultimately, it differentiates us in the marketplace against our competitors. And all those things are perceived as being a value add supplier, right? It allows us to help our customers reduce risk and ultimately reduce cost. So the model has proven to be very successful, right? I mean, we're growing at almost 2 times industry rates, and we continue to think that we're competing for a $27 billion addressable market. We're sitting here just shy at $1 billion in North America. So there's a tremendous amount of opportunity still to deliver that value proposition to our customers, which our investment thesis and the consolidation thesis has created.
Can you talk about how you work with HCI and Doug and his team to kind of get to the future state that you're marching towards? Maybe what are some of the best practices that you say, okay, here's how you can be successful as a CEO working with a private equity firm?
I think you've got to make an investment in time on the front end, right? Make sure that you're aligned with your sponsor from a vision and values perspective around where you want to take the organization and how you think you can get there. I think you have to recognize that not all PE sponsors are the same. And this is a partnership. You got to view it as a partnership, and you got to choose wisely to make sure that you're building a business with somebody that you can relate to and that will challenge you in a way that's constructive and will allow you to grow, will allow you to invest, and give you the runway you need to operate. One of the things that I appreciate the most about HCI is that high expectations challenge how we're operating, but they don't proclaim to be operators of the business, right? They know where they can be additive and have done a really nice job kind of turning on and turning off their support. And as Doug mentioned earlier in the conversation, I think as we've grown our capabilities internally, HCI has remove themselves from some of those areas, right? I used to joke and say, hey, if HCI is in our office, it means we screwed something up. And then HCI would joke back and say, hey, we've had you for 9 years. If you don't know how to run this business by now, then we're doing something wrong, right? But that's kind of like the healthy banter. I think people who want to work in private equity and they want it to be a positive experience, you got to look for that, right? It's got to be somebody you respect and appreciate, but at the same time, they feel the same way about you and the team that you're building.
Doug, what would you add to that?
Listen, it all sounds so easy and obvious, but it's hard in practice. Is the nature of the relationship or the partnership, right? And I think a lot of times people get into the deal mode where they expect to sell their business and they think that the exit is the finale. And in some ways it is, and in some ways it's like the beginning of the race, right? And so just make sure you're thinking about both chapters of the book here. I'm selling the business, and then there's the afterlife. And different relationships evolve differently, but this concept of trust and the ability to have really open and candid conversations about what's good and what's bad and how we're going to work together through the journey, I think is important. I think the other thing is, if you said to me, what are the attributes that make someone like Scott in his position successful? I think it's been interesting to watch him evolve from what I'll call a functional expert to a leader or general manager, right? And as he's evolved over time, he's had increasing roles of responsibility where he's much more focused on managing his managers than he is solving specific problems of customers or the business. And those skill sets are very different, right? So I think just acknowledging the difference in the skill sets and what you're playing to. And then I think for all of us, like I put myself in this category, I put Scott in this category. I think you got to be willing to be and want to be a perpetual learner, right? Because this is always like, we did better this year than last year, and how are we going to up our game again the following year? And so it's this kind of insatiable curiosity and the pride you get from the banter back and forth, right? Like we give each other a hard time, which is fun, but it's also our way to push each other to new and better things.
I love both of your perspectives there, and it shows the alignment. And Scott, you kind of hit the nail on the head when you said you're kind of in a relationship or a partnership with your sponsor. And in your case, it's gone on almost close to a decade.
Yeah. And listen, I've had the ability and had the support to go and bring in and build a team around me that has worked for several decades of private equity sponsors. And I know through them that not all sponsors are created equally. And the relationship is not always as transparent is probably the right word. And I think that it's taken, one of my biggest challenges has been convincing the team of sharks that we've brought in to help lead the organization to trust that this isn't a gotcha culture that we've created with HCI. And it's truly collaborative and it's been helpful. And it hasn't always gone well. I mean, we've had bad years and we've had challenges and we've placed bets that have worked out great and we've placed bets that have struck out. But there's more chips on the table now than there were.
Kind of a metaphor for life, right? It's never straight up and to the right. It's more of in your case, it's like a 45-degree sine curve in everyone's case. But if you're hoping for up and the right in a straight line, you're going to be greatly disappointed and probably not going to be able to overcome the ups and downs in between. So I think that's a great way to think about things. And maybe with that in mind, let's talk about like what you're seeing going forward. So what are some of the things that you're thinking about as a business leader now about the challenges and opportunities and how you're hoping to kind of navigate this to continue to kind of plow through in your value creation path?
Look, I think some of the challenges we face today are the same challenges, and this becomes frustrating, but it's some of the same challenges we faced 4 or 5 years ago. And it's because these challenges kind of recycle when we're highly acquisitive, right? And so I think leveraging the capabilities, our core competencies across these new acquisitions and doing it in a way where it doesn't shatter some of the culture or the backbone of some of the companies that we're acquiring, that's a big challenge, right? And I think that if we get that right, everything moves a lot faster and we're able to leverage the foundation that we invested in, right? The people, the foundation, the integration, all those initiatives that have created value and ultimately get to the next acquisition target. But managing the change associated with leveraging those capabilities is incredibly challenging, at least from a micro level.
It's human nature. Change is scary, and I think everyone tries to resist it. What are some of the kind of the ways that you help inspire the team to get past that first phase of fear and repivoting it into kind of opportunity and excitement?
It starts with culture and a culture of transparency and openness around where we're trying to go. And I think you got to define the end state of what we're trying to achieve and engage and include as many parts or people or everyone in the organization in that process. I think no matter how much you communicate, you're still under communicating. And no matter how clear you think you are being around who you want to become or how you're going to get there, there's always new people in the organization. There's always another company that hadn't heard it before. And so there's this need to constantly re-communicate and reinforce kind of that desired end state. And I think explaining how everyone in the business can play a part and play a role in achieving that is really critical to create that buy-in.
I think one of the ways that Scott has done a good job of helping the organization navigate change is bringing seasoned team members into the fold who have been there, done it before, and seen it. And that does two things. One, it brings new insights and perspective to the table to navigate the challenge, whatever it is. And secondly, people level set and they see the quality of the people you're bringing in, and it gives them comfort and confidence to kind of navigate that change with the organization. And then just in terms of like things I'm focused on that Scott mentioned in the coming year, I think that this business has a unique opportunity to really cement itself with its customers as a strategic partner as opposed to a supplier. And what I mean by that is we've just navigated several years of supply chain disruption given the pandemic. And pre-pandemic, I think everybody took cost and supply chain continuity as kind of a givens, that you were going to get your product, it was going to be on time, and the only thing you're really differentiating was cost. And I think because of the supply chain complexity and the disruption that everybody's experienced, there truly is an opportunity to be more collaborative and share information with your customer in a way that you can offer more value. And so I think we got to exploit that opportunity while people are focused on it. 5 years from now, if there's been no volatility, people forget those lessons and they were expensive and hard learned. And so I think taking advantage of that in the ability to really differentiate ourselves in the marketplace, I think is important.
I think it's really interesting just listening as a spectator in this conversation. One of the things that's kind of striking me is we've talked about a lot of things that kind of keep on coming up again and again. It's people, it's process, it's integrated approach, it's serving your customers in more fulsome ways. And I'm hearing this again and again and again from both of you. It shows this alignment that you all have that isn't easy. And I'm sure it takes investment, but you can tell it's there because we've talked about similar things throughout this entire conversation. And it shows that's how it's done well. From an opportunity to look at and work with a large part of the PE world, and then having been at my prior self, at the risk of flattering both of you, it's impressive. And I hope it's a source of pride because I'm sure it came with a lot of work and effort to get there.
Yeah, certainly a lot of pride in watching what Scott and his team have accomplished and a lot of fun. And that's what keeps you coming back.
And the only other thing I'll say, Scott, on one of your points that I really latched on to that I've learned, having been most of my career a private equity investor, now a founder and CEO of a company, is this concept that you've mentioned. I don't know who I took this term from, but like we all have to be chief repeaters because like you just have to say things again and again and again. And then you're so excited when you see it in the wild come back to you. You're like, oh, wow, that worked. So that's been something I'm still trying to figure out. So it really resonated to me. It's like, yeah, he's right. I just figured that out.
I say to Doug all the time, I said, man, don't you get tired of repeating yourself? But you keep saying it because we got to retain it. It helps to keep hearing it.
All right. Well, this has been a really wonderful, enlightening, and for me, educational conversation in terms of kind of showing the way the world works here, maybe behind the scenes from what everyone doesn't necessarily get a chance to see every day.
Awesome, Sean.
Yeah, appreciate it.
Thanks,
All right.
Scott.
Thanks, Doug. Thanks, Scott.
Special thanks to HCI Equity Partners, a lower middle market private equity firm focused on driving transformational growth through consolidation strategies by partnering with family and founder-owned manufacturing, services, and distribution companies. Learn more at hciequity.com. ICV Partners, an innovative private equity firm supporting management teams of leading companies at the lower end of the middle market. Learn more at icvpartners.com. And finally, Blue Wave, the Business Builders Network, connecting the most proactive business builders in the world with the best of the best service providers for critical, variable, on-point, and on-time due diligence and value creation needs. Learn more about Blue Wave at bluewave.net. For further information on HCI, ICV, and Blue Wave, and relevant topics discussed here in the episode, please see the episode notes for links.
The views and opinions expressed in this program are those of the individuals presenting and do not necessarily reflect the views or positions of any other persons or entities, including those referenced herein.